I I'd like to tell you a little bit about how I see the world right now because I don't know, who's managing it, Scandia or what kind of strategy you have, but I'm kind of familiar with them. And normally it's one of these well-diversified strategies. You select low risk, moderate, high risk, and then they do their best to buy bonds and equities. But it is very generic. It's following the old school methodology of portfolio management. And since 2008, and particularly since March 2020 of COVID, everything I learned in London School of Economics, if I want to apply it today, I would think about how I want to apply what I know and then just do the total opposite. Yeah, the world is so manipulated, and I'd like to share my vision of this with you. So let me, if you will, share my screen, and I'll show you what I think is the most important thing for investors to understand when they invest in their markets. Okay, so this is the S&P 500. Okay, this is the top 500 companies in America, like the index that you would buy, like the SPY, SP 500, like the Nasdaq or whatever. It's just a basket of the largest 500 companies. This is what I use as the benchmark for the world. If I'm looking at what's going on in the world, the problem is most people take a kind of short-term myopic view of what's going on. So if they're just looking from back to 2016, that's okay. The market's done pretty well since 2016. It's up about 171%. That in itself would scare me to be investing in the markets at this level, considering we have tariffs and trade wars and real wars and climate change nonsense and all this crazy stuff going on, which the world's gone completely crazy. So the thing is, that is nothing when we go back and compare where we've come from. So from the highs of 2007, the market is up around 260%, 270%. So the question's why, right? Yeah. So is it because we've got 260% more people consuming? No, it is not. So let's go back in time and look when the world was normal. Okay. When I mean normal, when things kind of, things would run in like cycles. So here we have a situation of growth, low interest rates, driving low inflation, which allows consumption to happen. But through that expansion phase that we have, we get to a consolidation phase where we simply can't consume anymore, even though everybody wants us to, because inflation's up and the market starts to slow down, and eventually it will go down into a contraction, start of a recession, and then something breaks, like the dot-com bubble here, and the market came down. But the market was already in a recession before the dot-com situation happened. Then the market goes into consolidation at the bottom, interest rates come down, we go from that recession into more stimulus again, and then we get another growth phase. Same thing happens, we kind of plateau here, market goes into recession, and then boom, financial crisis. Everyone thinks back to financial crisis, thinking that triggered the drop. The market was already losing money, we were already in a recession, that was just something that broke on the way down, and that's normally what happens. The thing is, what happened here was the bailing out of the banks. So Ben Bernanke it was actually a genius move in a way, because he started to print money, but unlike what they did during COVID, he gave it to the banks. So he rewarded the banks that bankrupt the world, even though they'd made billions of dollars in bonuses doing so. Instead of printing money and giving it to the people who deserved it, he gave it to the banks. But what he gave to the people as a consequence is he made the banks buy the treasuries. The price of treasuries went up, and as a consequence, interest rates came down. So instead of giving people money, he gave them free credit. That's a kind of genius move if you want to control people, because if you keep people in debt, they have to get out of bed and go to work. If you give people $500,000, a lot of them won't turn up to work the next day. So
that's right.
They basically enslave their population, rewarding the bankers that broke the market. But then we go to this super cycle where we get up to these valuations. So how can I back up what I'm saying? There is only one reason why corporate valuations are so high, and I can show you what that is. So what we're looking at here is money supply. From 1997 till 2007, money supply over those 10 years was around 29%. So we had an increase of around 3% a year in money supply. That's normal situation. But when we got to the financial crisis, just to bail out the banks, we went from $1.3 trillion to $1.6 trillion overnight. That was 16%. So let's say like 5 to 7 years worth of money printing just to give to the banks. But then they went to quantitative easing 1, quantitative easing 2, raising of the debt ceiling, and we went all the way up to $4 trillion. Then we hit COVID and they just went nuts. They were giving money to anyone who wanted it. They weren't even checking. We went up to 20 trillion. But now, because we have inflation and there's so much debt in the system, if they do keep printing money, they're going to keep posting this problem. So now we're seeing retraction on that. Now, if we just jump straight away back to the stock markets, then you can see a direct correlation between what I'm talking about and what has happened here. So come back here. So when money supply is normal, the highs and the lows stay within a normal range. But when you start increasing money supply, you have a direct correlation to the value of equities, and that goes up and up and up and up and up and up until you drop a bomb on the market of money supply. And let me just try and get this into perspective. So then you get to here, then you get a bomb of a money supply and then a massive acceleration. And now that money's coming out, we're starting to see, obviously it's because of tariffs, but it all kinds of catches up to itself. Okay.
Yeah.
So if we go back and look at corporations now from an investment point of view, this is what worries me about Scandia and generic investments, because until then it works. But now, is it going to continue? Because no matter what happens with strategy, if the money isn't there holding this thing up, if the money's not being printed, we could go through 3 or 4 years of volatility, negativity, and no real growth. You could have an emotional roller coaster, because what's the problem? We have inflation. The real world inflation is nothing like the printed figures. If you go to a restaurant, you know, use energy or anything like that, you're going to have an inflation more like 6 or 7% a year. So if you want to make your money grow above real inflation, you're kind of forced to take stock market risk. But if you buy all, like, for example, all these 500 companies, a lot of them are massively overvalued because of this money printing. So there are times when you want to be in an ETF or in the NASDAQ or in the S&P 500. And those times are when you believe that everyone's going to benefit from growth. So low interest rates, low inflation, global harmony. We're not there at the moment. So therefore, I wouldn't bet on the whole market. What I want to do is understand value as an investor, kind of like Warren Buffett. So how do we understand value in the stock market? There's 2 very easy ways that we can understand value. Oh, sorry.
Yes.
So this is what I use. I use a PE ratio, a price to earnings ratio. Don't know. So I'm making a mess here. We use a price to earnings ratio. So basically, if you were buying a restaurant and they said, we're going to sell our restaurant for $10 million, you'd say, okay, how much money do you make a year? And they say $1 million. Well, you've got a price to earnings ratio of 10 times. Okay. And it's going to take you 10 years of earnings to recover your investment. But then we look at the book value. Okay, well, what does the restaurant own in assets? Tables, chairs, the building itself, whatever that may be. Maybe the restaurant has $2 million worth of assets, and therefore you're paying 10 million. You've got a 5-to-1 ratio on the book value. So this is important, because this is the first thing we should always look at whenever we invest in the stock market, is to understand what is the price we're paying on their assets and what are we paying for the revenue that these companies are producing. So the long-term average price to earnings ratio is 15 times, and the long-term average price to book ratio is 2.8 times. Today, where the stock market is at 28 times earnings and 5 times book value. So we are double the book value and double the earnings of the long-term average. So I would not be buying any business that is at a premium of twice expensive as its average value. And also, because we're not in average markets, I don't want to pay an average price. I need a discount for all the problems that we're facing in the world today. Because if I buy stocks that are trading at a discount, when the world collapses, they don't really fall very much, because they're already so cheap that none of the investors that own them want to sell them. Like if you bought a house in Bogota worth $1 million and you paid 750,000, and you know the average value long term is around $1 million, but then there's a housing crisis, it goes down to 500. You're not going to sell at 500 just because there's a crisis. You know you've got value. You're just going to wait for that value to happen. And so we take the same approach with the stock market. So how do we do this? And let me give you some examples of what I can show you. So let's take, you know, a stock like Tesla that everyone talks about, obviously getting a bit of a hard time at the moment.
Yeah.
But for me, I'm agnostic really when it comes to what's going on in the behind the scenes. But look at this price to earnings ratio, 154 times. I couldn't in my right mind explain to anyone why I can justify paying 154 times their earnings on this company. Now, if I look at the financials, we can look at the price to book value. And the price to book ratio is 12 times. Whereas the average of the S&P 500 right now is 5 times. So, I mean, they're so much more overvalued than the entire market. The risk of them collapsing in price, regardless of what they do in the company, is very, very high. So what I do when I try and find stocks, I say, what can we find here? How can we find good value, good opportunities? Number one, I need the companies to be cash rich because we've got high inflation and high interest rates. So if they're not cash rich, they're going to be suffering. But if they are cash rich, they have an advantage over their competition. And if the market crashes, they might be able to acquire some businesses, kind of like Facebook does it for Instagram and all these other businesses. So that's one of the things I want to see in this market is cash-rich companies with low price to earnings ratios and low price to book values. I will filter the market and then I'll get about 100, 200 stocks. And then I'll start considering the more macro conditions, like what's going on with tariffs. For example, NVIDIA. So like with NVIDIA, why do I like NVIDIA? Although it's trading at a high price earnings, when you understand this business, this is a business that I would be willing to pay a high price earnings. But considering that they've been at price earnings at 50 times, 111, 75, 55, where they are around 35 right now is actually pretty cheap. But the reason that I like and I would consider NVIDIA at this level is because it had a nice correction because of tariffs. But the most important thing for me during tariffs is this, their net profit margin is 56%. So even if they're facing a 20% tariff, they've still got a 30% profit margin without changing their prices. Now, if we take their closest competitor, which is Advanced Micro Devices, and we look at their profit margin, you see they have a net margin of, it's really, for me, it's all about how do we manage risk. So as long as we manage risk and we've got room for failure, we're okay. But if you have to be perfect, you're going to fail. So I just want to show you some examples of companies. So I did a filter a few days ago using this methodology. One of the companies I found was Diamondback Energy Corporation. And you can see here, they're trading at a price to earnings ratio of 8 times when the average of the market today is around 25 times. So we're getting a massive discount. They are in energy supply. They have a positive net income of 3.3 billion. So they're cash rich. They have a strong revenue and they pay even a nice dividend on their stock of 2.97%. If we look at their book value, we can see, statistics. We can see that basically you're buying the company for the value of its assets without any markup at the moment. It used to be trading to double that price at 2 times its asset price. So this is a company, for example, a stock based on valuation where it's already down by 35%. We see a lot of price support at this level as well, but this is one that I expect to come back up, particularly as it's in energy and particularly because it's based in the US and what Donald Trump is going to do as protectionism movements in the US. So this is a list of all companies and they're all from different areas that meet those requirements. Now, the thing is, no matter how good we are at picking a stock, it's like planting a seed. If there is no rain coming, that seed can't grow. No matter how good the seed is, it's going to stay there and you're going to have to wait and wait and wait. And the longer you wait, the more opportunity costs you have, the more cost of inflation you have. So how can we in this market be smart enough to buy good quality assets, protect ourselves from the downside and still make money if the market is flat or negative? And this is where we are very unique because we developed this platform. So let's imagine that I'm going to use some big names like we just looked at, like NVIDIA. Let's imagine we have NVIDIA and Facebook and I don't know, Tesla, whatever. It doesn't really matter. This is just an example. So let's imagine for whatever reason we selected these stocks. What can I do? Rather than us buying the stocks and hoping they go up in value, I can say to the bank, I want to be protected. Even if these stocks lose 50% of their value, I don't want to lose any money. And I just want to get paid a strong cash income, a double-digit income, cash flow every single month, even if the stocks have lost 50% of their value. I want to have a minimum investment horizon, I don't know, 3 months, and I maybe want to have a maximum horizon of 3 years. So what we're doing here is we're saying to the bank, we like these stocks. We
Yes.
we don't care if they go up in value. We want to ensure our risk of the downside. And what would you pay us as an income if we were to have this strategy? So what I'm doing right now, I'm sending my idea of an investment strategy to all the banks in the market. They're looking at these and they're going to say, I'll give you 9%, I'll give you 10%, I'll give you 15%. So what we're doing here is doing a B2B, like a bank to bank.
Yes.
Price. So this is, you would never see this pricing, and you would never be offered these strategies unless you had $20 million in the account, because then you'd be in real private wealth management. But for generic retail investors, they don't even get shown these strategies. If they do, they have a big markup, 5 or 6% commission, which is taken by the banks. So what I wanted to do in my business was always try and use my knowledge and my connections, the volume of my collective client base, to give retail investors a much more institutional level service and independence, rather than, I'll buy this fund because I get paid a commission. No, let's see what you need. Let's see what you want in terms of protection, income, and strategy. Let's see what's in the marketplace, and let's design strategies tailor-made for these clients, cutting out all of the guys in the middle that are going to make this an expensive operation. And by doing that, and by being so efficient with price, it leaves an excess yield. And that excess yield means we can buy insurance to protect against the downside of a bad outcome on these strategies.
So you got it. You nailed it right. That's your line, and it's okay for me, Charles. I'm really amazed the things you're doing, and yeah, really I get excited about this.
Me too.
Yeah, that's fine. So
Yes.
what would you suggest that I should have to know, or things I need to search a little bit more, or what do you expect would be my next step into a quite neat proposal from you?